What is up, YouTube? Welcome back to Stacks About the Numbers, and I wanted to do a quick overall analysis here of a company that you may not be familiar with, however, as you see, has been absolutely raging over the last couple of years. This is a company called Limbach Holdings, ticker symbol LMB, listed here on the NASDAQ. Stock dipped below $50 a share today, $49.86, down 60 cents. 1.2% here on the day, recently coming off highs of a touch below $53 a share. And you can see back here, we're looking at about summer of 22, stock was down to $5. Now we're up at 50. So this company has went on a massive run, and a lot of people may not understand why, if it's justified. Will it keep going? Should you get in, potentially ride the wave that's still coming, or if we can maybe get a better price? So just off the bat, overall, obviously the stock has been doing very well. So if you own it, congratulations. And I'm not bashing your company, but honestly, in my opinion, I do feel kind of mixed here. And I just want to explain my point, but obviously this is just my opinion. But LMB, market cap, we'll call it 550 million for now. We got a PE of about 23.5. That's not too bad. But my main concern is that there's an HVAC company, right? Heating, cooling. And I feel that a lot of the real estate boom has potentially passed already. And I spoke about this in some previous videos, and in the earnings videos, when we looked at companies like Geld, J-E-L-D, and Weyerhaeuser, W-Y, right? These are lumber companies, wood products, which obviously used for, home building and renovations and whatnot. So I basically kind of assumed, I had this gut feeling that the real estate market just kind of slowed down and that those companies were going to come in light with their estimates and they were going to miss earnings. And it turned out both of them did, and they both dropped lower. So in my opinion, I'm not saying that this rally technically shouldn't have happened, but I feel that we may be beginning to start to slow. So overall, we could potentially see more growth here in LMB, but in my opinion, I just think we could get a more attractive price. That I'll say that. Because some of the margins look good, and if we look at some of the numbers here, we could make the argument that it's undervalued, right? The PE 23.5, I mean, that's right around average, right? About 20, 22, 24. The market cap, though, 557 million. As you see, for 2023, the company brought in 516 million, and the profit margins increased as well. You can see they were holding about 1.33% net margin for 21 and 22, and now for 23, it jumped up to a little over 4%. And what they said they were doing was, of course, they were focusing on shorter time frame, higher profitability projects, but also more importantly, they're kind of doing direct to consumer as opposed to going through the general contractor that they speak about. And apparently it's just been a little bit of a better turnover. And of course, it's been a little bit less expensive. So they're able to kind of maintain the same amount of revenue. But as you see again, they're able to be slightly more profitable. So in the numbers overall, again, we could make the argument easily, even if we go 1.5 times this annual number, I mean, we still have, 30, 40% room to the upside potentially. So, we could be looking at like a $70 stock, no problem, in my opinion, no problem. However, I do feel that if we look at last quarter here that was reported about a week ago, May 8th, you can see, again, the profitability side completely turned around, the company killing it on the EPS side. The revenue side, though, came in a little light. And as you see here, on 122.25 million estimate, the company posted a little less than 119 million. So if we go back that same time last year, that was this quarter, you can see estimates were 115, they posted 121. And now we're down to sub 119. So it's not a huge drop, but technically we are slightly down from the same amount we brought in last year. And also the estimates for next quarter as well. So, supposedly they say, oh yeah, it was a good quarter, even though we came in a couple of million light. It's a seasonality business, right? This is the period ending March. So that was January, February, March. So we know there's a lot of areas. Those are the cold months. So you're not as productive. Okay, fine. Fair enough. But now, April, May, June, right? Now these are, now you're gearing up into the warmer months, and this is when you should really be rocking and rolling. And my apologies, Steam Friend, and also the next quarter afterwards as well, right? So 122.25 estimates, 122.65 estimates. So this is what I mean. I appreciate the fact that they're kind of maintaining a similar estimate, but also at the same time, I feel like they know as well that the market is slightly beginning to soften, which is why, again, the estimates just kind of staying in line, not really being increased. And if we look here, you can see for the revenue coming from owner direct relationships. You can see it's been growing very, very nicely. And just over the course of the last couple of years here, look at this, coming out of 2020, you can see for 21, 140 million, up to 216, up to almost 262 million. However, during the same time frame, they lost about 180 million off the GC relationships with the general contractors, going from about 441 million down to about $250 million. So even though this swing, technically, again, these projects might be more profitable for the company overall, it technically is a little bit less revenue. So I do have a few personal concerns that I'm seeing here, but overall, a lot of the margins have been increasing. So, you know, if you tell me you're still bullish and you still see $60, $70 a share, I can appreciate where you're coming from. The EPS side has been very solid, as you see here, beating EPS estimates 7 of the last 8 quarters, the last 7 quarters in a row. So the EPS side doesn't seem to be an issue for me. I'm more worried about the revenue side, as you see here. We had a good stretch here, about 4 quarters in a row, and recently missed last quarter, but the company beat only 4 of the last 8 quarters. However, this entire time, while they were missing these estimates, the stock continued to climb and continued to climb. So this is why I get concerned, because when we have stocks that climb, when they technically should go down because they just missed earnings, that, in my opinion, could be a slippery slope. Because you guys know I always speak about a potential correction that could be coming. And I always mention these negatives, again, not because I don't like the company or I want you to lose the profits you're up. That's not what this is about. At the end of the day, what I'm trying to show you is, in my opinion, if there are negatives surrounding a company, if there is a reason as to why the stock could go lower, then if market's correct, the stock will go lower. So if we had a lot of this pump beginning off of a company missing earnings, again, then technically the continued pump that came off of beating these revenue estimates should have been less weighted, in my opinion. And now the company just missed earnings and the stock dipped down but immediately spiked back up to higher than where it was before they posted earnings. If we look at the annual side, same thing, mixed bag. Now remember, we were climbing here throughout 22 and 23, but technically the company was coming in with some light revenue here throughout these years. And we can also see the company was up about 550 million, almost 570 million here in 20. And now you can see for 23, we're back at 516. But look, until 2025, we're not going to get back to that 550 plus million mark. So again, I'm not necessarily saying the stock should go back to like $5, $10, but at the same time, we did go on a massive run when technically we're not even back at the business level that we were at, 5, 6, 7 years ago. But on the EPS side as well, we can see this is interesting as well, because we're potentially pumping the stock off a solid profitability side and kind of ignoring the revenue side. Yet if we look at the broad picture of the business, the company's missed on the EPS side for the last 4 years in a row. So again, from 2020, you can see 4 misses on the EPS side, 3 misses on the revenue side, and finally came in above estimates here in 23. So even though the company is rebounding, I'm sure you guys can appreciate my point. It's not technically completely positive and full of green flags. So a pullback can potentially happen. Look at the PE here at about 23.5. We can see a couple of quarters ago we were up to a little over 25, but before and after that we were sub 20. So the PE now kind of second highest it's been going back the last 7 or 8 quarters. So we can be potentially due for a pullback. Price to sales up here 1.17. That's the highest it's been going back the last 7 quarters. Price to cash flow now. The cash flow actually recently went negative last quarter. But again, might be a slight speed bump, but we can see the company right now trading 13.6 times cash flow. That's the highest it's been going back the last several quarters. Price to book is now above 4.5 times book value. That's the highest it's been the last several quarters. The enterprise value, again, something I don't necessarily personally put a lot of stock in, but the enterprise value is supposedly what another business would be willing to pay for this business. And you can see the enterprise value is basically in line with the current market cap of this company, which is why I'm saying again, not that the run shouldn't have happened, but it did just kind of straight beeline up, regardless of what the numbers were and what was being reported. So that's why, again, I'm just saying, in my opinion, we can potentially be due for a pullback. But a lot of these ratios and a lot of these margins look pretty good, and I can't deny that. All of our return percentages are up, as you see, climbing nicely over the quarters. The gross margin percentage was at 20, climbed into the low 20s, and you can see here getting up to about 24 and a quarter, back down to 22.7, and now back up to 25 and a quarter as of last quarter. So the gross margin technically is the highest it's been going back the last 7 or 8 quarters, so that's a good sign. The operating margin, as you see, was bouncing around like sub 5%, started to climb up here 6, almost 8, pulls back to 5.4 as of last quarter 5.7. So it doesn't seem like it's a big deal, but this time last year we were at about 4%. Now we're at 5.7%. So the operating margin does have these pops and these drops, but technically the company seems to be in a better position than it was this time last year, which technically is a green flag in my eyes. EBITDA, earnings before interest, taxes, depreciation, amortization. We can see basically same thing, like the operating margin, right? Bouncing around up and down, now getting as of last quarter to about 8%, but this time last year was at about 6.33%. So climbing nicely year over year, heading in the right direction. The net margin percentage, we said they're focusing on shorter term projects, higher profitability, and of course going direct to owners and not really bypassing, but going direct to owners and not going through the general contractors. We can see that has benefited them on the profitability side. Asset turnover up and down, basically in line. Our debt to assets, as you see, was dropping down here, 0.19, 17, down to 0.13, now back up to 0.15. Maybe not necessarily the biggest red flag, but I just thought I'd mention it. Debt to equity, yeah, dropped down, basically in line. Long-term debt, total assets, dropped down to 0.11, now back up to 0.13, kind of where we were about this time last year. Long-term debt to total equity, dropping down. Okay, so let's switch over here to the statements, and we can see the assets, same thing, basically in line. We got above 300 million a couple of times here on the total assets, and we can see we recently pulled back to about 289 million. The liabilities, though, have chunked down, and we can see the liabilities last quarter 192 million, now down to 163 million, and that's the second lowest it's been over about the last 7 quarters. So that's heading in the right direction. And of course, assets minus liabilities yields total equity. And you can see the equity seems to be consistently climbing here quarter over quarter, getting above 125.5 million, which of course equates to a higher book value per share. As you see, almost 9, almost 10, almost 11, and now above 11 here at 11.14. So again, a lot of these numbers are growing nicely and heading in the right direction. I just feel like because of the mixed earnings, we just can't be on the up and up no matter what. And honestly, that's kind of simple logic and common sense. So again, a lot of good things going on with the stock. However, there are a handful of negatives as well. So in my opinion, basically, my point is, long term, I do still see growth. However, I personally feel that this sector may be potentially softening. We have lower estimates now year over year. We just missed revenue estimates last week on earnings. Stock went from 5 to north of 50. And, now I just feel like it's due for a pullback. Potentially low 40s or high 30s if possible. Excuse me. The one thing I will say, though, is look at the cost of goods sold. Cost of goods up here almost 100 million, and we can see almost 115, 110, but maintaining about the mid to high 90 million mark. And we can see for last quarter, cost of goods sub 89 million. So in my opinion, that's actually a very, very good sign. The problem is because the revenue was light, we actually saw the gross profit go down. Total revenue minus cost of goods sold yields gross profit. But overall, in the longer term, the gross profit has gone from the mid 20 million mark and got above 30 million here now for 3 quarters in a row. So in my opinion, that's a pretty good sign. The operating expenses jumped up a little bit here, about 15-20% here, quarter over quarter, going from the low 20 millions up to almost 25 million. Last quarter back down to 23 million, but technically higher than they were. But gross profit minus operating expenses yields operating income. And we were looking at those margins as well. And again, we can see it technically dropped here over the last couple of quarters. But if we go back, this is Q1 of 24, operating income 686 million. Q1 of 23, we were at 479 million, right? So a lot of these metrics are growing year over year more than quarter over quarter, which again, I will say, if you're bullish on the company and still see more growth, I can appreciate where you're coming from. But again, we always talk about pricing and timing, and the main point here of these videos, again, not necessarily, if you're involved in this back from like 18, this might not really apply to you. If you weren't aware of this company and you see the growth and you're considering getting in, obviously this may be a little bit more pertinent for you because, again, we always speak about, like I said, pricing and timing. So of course, if you can get this for 39 or 41.50 as opposed to 50.49, obviously it'd be that much better, right? So that's why I'm saying, in my opinion, I'm not bashing the company, but here in the short term, I just feel like we could potentially get a better entry. And the debt, as you see, about 42 million and change, the debt doesn't really seem to be an issue here. And if we come down, okay, so we can see the debt was actually dropping year over year. And excuse me, I got a fly in here. But as you see here, 65 million down to 62, 60, 50, and then sub 42 million. So the debt's really been dropping down. And you can see coming out of this 2020 lockdown, you can see from 21, the cash was down here at about 14.5 million. And then we jumped up to about 36 million. Then we jumped up to almost 60 million. So the company, again, has some cash on hand. The debt was decreasing for the most part. And also the cash flow increased nicely here. Free cash flow getting to about 55 million for 2023. So we do have some good. We do have some bad. But also we can see it seems like Q1 is where the debt jumps up again. Because the debt here was 49 million down to 40, down to 38. Then we started to gear back up again, right? Debt up here to almost 42. And now for last quarter, 42.67. Is it a huge deal? No, of course not. But technically, the debt did go up a couple of million, so, had to mention it. And the cash as well. We can see we had a little drop down in cash here, but technically, we are holding more on cash Q1 of 24 compared to Q1 of 23. 41.5 million in cash, up to 46, 57.5, 60, back down to 48.3. But 48.3 this time last year, we were at 41.5. So the cash climbed, like a good 15-20% technically year over year. But look at that free cash flow as well. We can see the last couple of quarters, free cash flow 16.35 million, 16.95, down to 13.33, and goes negative as of last quarter, minus 6.5 million. So this is why I'm saying we do have a lot of positives. But of course, we have a handful of negatives. And when I personally see a stock and we're kind of mixed, where we can make an argument where, again, if we slowly climb up to 60, I can kind of understand it. And if we were to start pulling back to like 44, 43, 42, I can also kind of understand that as well. So kind of middle of the road here with Limbach. But assets outweighing liabilities, we looked at that before. But again, the debt technically did rise a little bit. But my main concern is, again, the fact that it's going to take till 2025 to get back to 2019 and 2020 numbers. And I'm not necessarily saying that the stock should be completely beaten up because of that. But, I mean, this is a pretty big run here. And we can see, coming out of 2020 here, look at this. We beat on EPS, we miss on revenue by a mile. The stock dips for a couple of days and then starts to explode. We got a nice beat there, top and bottom line, beat, top and bottom line, beat, top and bottom line. But again, remember, this is coming out of lockdowns, and throughout 2020, 21, and 22, in my opinion, that's really when a lot of the real estate started to boom. A lot of people rolled their money into real estate because they felt that it was probably, the most stable and safest investment. So we can see the company was rocking and rolling for a while, right? Then we come out, we beat on EPS, we miss on revenue, miss on top and bottom line, miss on EPS, beat on revenue, beat on the top and bottom line, and beat on EPS, miss on revenue, beat on revenue, miss on EPS. And now, right here, August of 22, you can see we spike up here after these earnings, but we missed on both the top and bottom lines. Stock began to climb. Then we come here, next earnings, you can see we took another leg higher, but we missed on revenue, even though profitability increased, right? And then we just continued to just rage like an animal, even though, again, technically, we missed on the revenue side, but we beat on the EPS side. And then the company was able to string together multiple winners in a row here, as you see. 4 quarters in a row, beating on the top and bottom line. So this additional rise during these beats, of course, in my opinion, makes 110% sense, right? But the fact that we had such a strong bounce and we're climbing even though we were missing estimates this whole time, in my opinion, doesn't necessarily add up to me. Which, again, is we will eventually become realistic again. That is the point I'm trying to make. We will eventually become realistic again. And of course, if you're holding these stocks or if you're playing like index calls while we just consistently climb for no reason, then of course, you're happy as a pig in shit. You don't want to hear any other viewpoint and everything's great. You're making good money. The markets are fine. But again, we went on, like I always speak about, we went on like this 6-month rally because supposedly inflation was cooling and the rates were going to be cut. And now we're finding out that inflation is not cooling and we haven't seen rate cuts yet. So whether we get good news, bad news, or middle of the road news on our economy, if we're just going to go up no matter what, then this is why I say that we will eventually, potentially, go down no matter what. And we may get to a point where even if good news is coming out, we're just going to consistently start dropping just because we ran so much for so long. So, and in my opinion, again, to compare it to Limbach, it's a similar feeling because you can't consistently be inconsistent, but still climb in value. And again, notice it's only for like select sectors and select companies where you see things like that, right? I used to always speak about Goodyear Tire. And if you look, why has Goodyear Tire been basically flat for a few years? Well, it's because they constantly come out with mixed earnings. One quarter, the EPS is good, but the revenue is light. The next quarter, the revenue's in line, but the profitability dropped off. The next quarter, they beat on the top and bottom lines, but cite weakness moving forward the next 1 to 2 quarters. So, the stock has these little pops and drops, but essentially stays flat. You don't see a lot of companies who are mixed and inconsistent going on a 1,000% rally like LMB did. So, technically it is all about earnings, but this company could have also been very beaten up and very undervalued. Again, we make the argument here that we're essentially in line with the market cap to annual revenue. So the fact that the stock was down here, I can appreciate the fact it was very beaten up. And even like this run back up here to like 30, very, very understandable. Very understandable because it was probably flying underneath the radar. Again, a lot of people may not have been paying attention to this one, but, the revenue was for the most part remaining steady. And the stock just overall was viewed as undervalued. So we went on a massive tear. But if we come up here looking at the technicals, not really, but we're maybe kind of making a head and shoulder pattern here. But again, you can see this is when the earnings came out and we missed on revenue. And the stock was sitting here at 48 and a quarter. Then we dip down to 43.78. Don't even technically touch that fib. And then we explode right back up to above 52. So in my opinion, that wasn't supposed to happen. And this is my support trend line here. You can see connecting the bottoms there of January 18, 24, going across to April 10th and April 16th. And that's just cutting across, touching those candles. And you can see that if we were to pull back to this support level, 39.98, I'm personally looking for a pullback to about $40 a share. Now, I know it seems like a lot, 20% pullback, but again, the stock just went from 5 to north of 50. So, you know, we do have to have some sell-offs and some pullbacks eventually mixed in there. And believe it or not, it is healthy. It's not necessarily a good sign when a stock goes up and up and up, because then the average investor, that's when they hear about it. That's when they jump in, and then that's when the sell-off and the correction takes place, and then they get screwed, right? So this is why I say sometimes better off being patient. But in my opinion, I believe it should pull back to this trend line here at 40, and then if it bounces and wants to, you know, try to climb back up to the fib, very understandable. But here, in my opinion, I think it should pull back a little bit. And if we switch over here to stock charts, we can see that the RSI did top out, it looks like, at slightly above 70 here in the last day or two. And we can see we slightly got above that top Bollinger Band. Now we kind of started to drop down a little bit. But you can see also, look, it just immediately bounced off of that 50-day moving average when they technically missed earnings and has spiked back up. And that moving average there, we're looking at 44. And this is why I'm saying over the next couple of weeks, if we slowly pull back, we may potentially meet up with this 200-day moving average if we keep climbing, and that can get to maybe around 40, slightly above 40, and then the stock can meet up, bounce off there, and then maybe gain some momentum going into next quarter's earnings. And then we can see how the company reports. But overall, stock's been climbing nicely. These moving averages are climbing nicely. As you see, the 50-day back here, beginning of October, was at about 30. Now it's up to about 44. And the 200-day as well, off the screen here, before the bull drop, down here at 27, 26. Now it's up north of 38.5. So moving averages climbing nicely. We did have this little trumpeting now taking place because the stock really started to rise over the last couple of weeks and ride the top Bollinger Band. So we had a little trumpeting taking place, and now we have the curling happening on the bottom Bollinger Band, but now we're going to need the curling to happen on the top Bollinger Band, in my opinion, which is why I'm saying we're potentially going to start selling off. Again, RSI topped out above 70, still sitting here at 66, so we can potentially sell off, and this will help curl the top Bollinger Band and kind of form a little bit of a tightening channel here potentially, where we can just stay inside that range and maybe bounce off these moving averages and gear up to potentially pop and explode out on next earnings report if those numbers are good as well. But of course, you know, we'll see what happens. But the MACD recently crossed to the upside. It was about 3 weeks ago, and we can see been climbing nicely, potentially starting to curl here on this top out. So we'll see what happens. We switch over weekly. And I mean, look at this here. You know, look at this RSI. RSI, we're talking March to about September. The RSI was above 70. Look at this run here. And again, remember, these earnings were mixed. These earnings were mixed. Look, the stock didn't even come down, excuse me, didn't even come down and touch the mid-Bollinger Band. Just straight riding the top Bollinger Band the entire time. Then we finally have a pullback to the mid-Bollinger Band. And of course, we bounce, and we test again, and we bounce. And look, we actually recently broke here for a couple of weeks, and then, of course, exploded up, even though the company technically missed earnings. But look at on the weekly here. The stock, again, it looks so good here on this chart for a company, again, that has posted mixed numbers this entire time frame. If we were looking at something like, geez, I don't even know, because a lot of companies are mixed, but we're just kind of glossing over that fact and just making it sound like everything's positive, every company's beating, everything's great. But you know, if we look at a more consistent stock like a Microsoft or something, right? If a Microsoft had a chart like this, in my opinion, would be very understandable. Because even though we could make the argument that the stock may be overvalued, this company technically probably during this whole time frame was beating top and bottom line estimates every single quarter, quarter over quarter, right? And technically Limbach, again, we saw 4 beats, 4 misses. So technically the company hasn't been really performing at its peak, if you will, during this whole rally. So this is why I'm saying a sell-off could potentially be taking place, but the stock has not even tested the 50-day moving average since November of 2022. And again, I appreciate all the stock that people want to put in the real estate market, but again, we have mixed earnings. It's an HVAC company. In my eyes, it's just not this good. I'm sorry, it's just not this good, which is why I'm saying, again, in my opinion, I'm expecting a pullback to 40, potentially sub 40. But the moving averages obviously move nicely here, as you see. The 50-day moving average was down here at 7.5, the tail end of 22. Now it's up to almost 37. And the 200-day was down here at about 7.5, and now it's at almost 16.5. And we actually had the MACD recently cross to the upside here, but it does seem, again, like in my opinion, we may potentially start to pull back here to the low 40s and potentially the high 30s. But it's just speculation. It's just my opinion. But again, overall, I mean, technically the company has become more profitable, but it technically is on less revenue, right? Prices are up 20, 30, 40% across the board, especially for companies like this. So you're technically, you know, making more profits on less revenue, on less business. And again, I understand it may have been viewed as undervalued, so the stock is being heavily rewarded, but to not get back to that 550 million annual revenue number until 2025, essentially, you know, being below where you were for 4 or 5 years, in my opinion, is just not adding up. And that's why, again, could kind of go either way. If we climb up here now to this next resistance level of 57.92, I mean, I guess I get it. In my opinion, I think it's too much. And I do think we really should pull back. Maybe not to something like 34 here. But again, maybe that support trend line we drew out on the chart, looking for around $40 a share, in my opinion. RSI still high up here, 61 1/3 on the weekly. So this is what I mean. We can potentially start to calm down for a couple of weeks, come back down to earth, and then maybe get ready to gear up and take that next leg higher. Here on the daily, we can see next resistance level 52.37. However, again, it looks like we could potentially kind of make an argument for kind of a head and shoulders, but we'll see how it develops. But next support level here, 48.85. And you can see right when it got there, it technically rejected. And I know these earnings came out, but then it happened to jump up above it. I don't know. In my opinion, it's just not adding up. And that's why, again, I'm looking for a pullback here to the low 40s, try to retest that 50-day moving average. And then right here, believe it or not, would be perfect, in my opinion. Pulling back to a support, 39.92. That's just a handful of cents below my trend line here. Again, if we were to pull back, again, there's about 2 weeks. You can see we're at about 40. So if we drop down slightly, break, and then have a nice bounce, in my opinion, it would be healthy. In my opinion, it would be healthy. But that's pretty much all I have to say for Limbach. But if we check some recent news here, I believe they also lowered estimates here. But yeah, you can see the shift in segments here. As you see, revenue from owner direct relationships up 26.5%. Record gross margin, 26%. Net income up nicely. Here, increase in 24 adjusted EBITDA guidance range, 51 to 55 million. It was 49 to 53 million, I believe. So they raised it by about 2 million. So, I mean, you know, technically it's good news, but I don't know if it's that much good news. But again, this is just my opinion. Consolidated revenue down, technically. Gross profit up a little bit. We don't see, oh yeah, here. We are now projecting 51 to 55 million for the year to our previous 49 to 53 million. Annual revenue in range 510 to 530 million. Right? So technically we're not going to get back to that 550 million yet. But it showed, maybe it was a different article. It showed, it might have been last quarter's numbers actually. Let's see if we can go back, because they technically, yeah, see, took an 18% hit 3 months ago. Fourth quarter revenue declined. Taking a more selective approach to the projects we pursue by focusing on smaller contracts with shorter durations, which affected fourth quarter rep. But going forward, this should provide greater flexibility and drive higher overall returns, right? That's what I mean. So they're focusing more on flipping the projects quickly so that the margins and the profitability could be higher. But technically, if you're focusing on smaller contract, this is why the revenue, in my eyes, has started to dip down here. Full year revenue 516 compared with guidance of 490 to 520. So that was good. On Wednesday, projected annual revenue of 510 to 530. Nope. Where is it? Here we go. Limbach said it sees fiscal year revenue of 510 to 530 million versus market estimates of 541.1 million. This is technically a red flag. So this is what I mean. This is why when a company comes out, they were light on their revenue and they lowered their fiscal year revenue now for this year in 24. The fact that the stock immediately dropped 18% or whatever it was to 47 or wherever, and then all of a sudden it just runs right back up to north of 50, 52, higher than where it was before they missed earnings. In my opinion, that doesn't make sense. In my opinion, that does not make sense at all. And again, it's becoming unfortunate because I feel like we've now gotten into a place where people just buy for the F of it, and we're just pumping these stocks just because they're publicly traded companies. And the reason why people used to appreciate stocks and feel secure in them is because if you found a good business and business model to invest into, it would grow over time as the company would more than not come in above expectations and be growing as fast or even quicker and larger than Wall Street originally anticipated. That's how you knew you had a good stock. And now we've gotten to the point where, oh, you missed on the EPS side? It doesn't matter. We're going to bring the stock up. Oh, your revenue's dropping year over year and you just came in light? It doesn't matter. The stock's going to go up. Look at what happened with Tesla. Tesla missed earnings again. They have been consistently missing on the revenue side, coming in lighter and lighter. But what happened? The stock ended up taking off after the company missed earnings again because, I don't know, he spoke about AI or a ride taxi app or something again. I don't know. Whatever it is. Again, if you owned calls or shares, it was a great report, right? And you love Elon Musk. Anyone from the outside looking in, like we always say, men lie, women lie, numbers do not lie. And if you look at the numbers, Tesla stock should not, under any circumstance, have gone up, and it should have dropped down to about 120 in my opinion and made new 52-week lows. But instead, we rewarded a company that technically did not do its job. And this is why I'm getting a little adamant here, a little passionate on something like Limbach, because long term, 100% I see the growth. Here in the immediate short term, this stock could easily, again, like I said, pull back to $40, $38, $35 a share. And in my opinion, it would be 100% justified. 100% justified. But again, that's just my opinion. But I don't see any... Yeah, I'm not seeing much... I'm not seeing many upgrades here. Wait, let me... We only have two analysts watching the stock right now. They're both giving it a strong buy. This is what I mean. This is why I'm saying in the short term we could have a pullback. Overall, the gist seems to be that, like, these analysts feel, like I guess investors feel, and they basically feel that the whole situation is undervalued. And you see one price target at 56, one at 60, stock right now at 50. But I mean, just look at the tear the stock went on. I mean, all good things do have to come to an end. That's basically my point. And again, you know, as much as you may appreciate this run, and again, I'm not bashing the company, but as much as you may appreciate this run, it just seems very mixed in my opinion. It just seems very mixed. And again, you can see estimates for next quarter, 122.65 million. This time last year, they brought in almost 125 million. So Q3 estimates are higher than where they were in 23. So we'll see how the year plays out. But again, in my opinion, overall, I just feel like the whole real estate sector may begin to slow down and soften. That's just my opinion. And that's why, again, stocks like Geld and Weyerhaeuser, I called correctly that they were going to miss revenue estimates. I wasn't aware of this company posting earnings a week ago. My apologies. But honestly, I probably would have said revenue would come in light. And as you see, the EPS side was fine. Again, they're focusing on more profitable projects, but the revenue did technically miss and come in light. So in the immediate moment, you know, if I called puts on that one, it technically would have been correct because the stock pulled back to 43, but obviously very short-lived, and we exploded right back up. And that's why I'm saying when it's mixed like that and it's not consistently positive, to have consistent growth no matter what, in my eyes, could be dangerous. But I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky and volatile and very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day, guys.